how can we go beyond that basic $10 million exclusion? We've talked about how you are eligible for and claim the basic $10 million QSBS exemption. The next logical step, and where Valur tends to come in helping clients with this, is asking, how can we do better? How can we go beyond that basic $10 million exclusion? Peter's going to talk through a couple of vehicles that are relevant here. You can see up on the screen non-grantor trusts and charitable remainder trusts. But just to lay the groundwork, the idea here is that the QSBS $10 million exemption is written into the code in a way that applies to every individual shareholder who has received eligible shares. Peter talked through those requirements, the main one relevant here being the original issue requirement. If I get shares as the founder of a company and I give them to my kids or my cousins or my friends, they remain originally issued shares, and that person also gets to claim a $10 million exemption. Also importantly, and that doesn't work if you sell the shares, as Peter said at the outset, but if you gift them, then the recipient gets their own exemption. Also, very importantly, individual shareholders are defined here to include entities. And so you can give your shares to a trust, and that trust will get its own $10 million exemption. Now, there are a few different types of trusts that apply here, and they have their own kind of mechanics and pros and cons. So let's talk through a couple of those. Peter, if you want to.
Yeah. So there's a bunch of different types of ways you can stack, but there's a few basic common vehicles. And so probably the most common is what's known as a non-grantor trust. So a non-grantor trust is a type of trust that's a separate taxpayer for income tax purposes. A lot of trusts, probably the majority of trusts in the US, are not separate taxpayers at all. They're actually disregarded for income tax purposes. So like, for example, like a living trust, revocable trust, that's not a separate taxpayer. So it's not going to get its own QSBS exclusion. An intentionally defective grantor trust or a grantor retained annuity trust, those are not going to be their own taxpayers. And so those are just, treated as the same as the individual grantor of the trust. So they're not going to get their own additional QSBS exclusions beyond what the grantor gets. But non-grantor trusts are separate taxpayers. They pay their own taxes. So they get their own QSBS exclusions. And the sort of big picture idea is that, let's say you have two kids, you could set up a non-grantor trust for kid one and a second non-grantor trust for kid two. And each of those trusts would be separate taxpayers. And so they would each get their own QSBS exclusions. And so if you had $30 million of stock in your QSBS eligible business, you could gift $10 million of stock to trust one and $10 million of stock to trust two. And then you'd get your own $10 million QSBS exclusion. And each of those trusts would get their own $10 million exclusions. And so you'd actually be able to exclude all $30 million of gain on the sale.
Peter, you've been using the word taxpayer, and I slipped up and used the word shareholder. And that's an important kind of distinction. The general question is, who can be the beneficiary of these sorts of gifts and get their own QSBS exemption? Can it be literally anyone, or are there limitations?
Yeah, so it has to be a taxpayer who's separate from the grantor, and so there's a lot of situations where people think, I have a living trust or something, and I have some shares in there, then I have some shares in my own name. Can I get two separate QSBS exclusions? And the answer is that they have to be a separate taxpayer. So a non-grantor trust is a great vehicle, partly for that reason. The other neat thing about a non-grantor trust is that if you live in one of the states that doesn't conform to the QSBS rules at the state level, like California, for example, or New Jersey, you can actually gift shares to a non-grantor trust that resides in a state that's not California or New Jersey. So, for example, you can set up a non-grantor trust in a state like South Dakota, give shares to it, even if you're a Californian. Those shares are going to be owned by essentially a South Dakota resident trust. And so, when the South Dakota trust sells those shares, it's going to be treated like a South Dakotan selling the shares. And so you don't have to worry about California income tax on those shares. And then another common type of trust that we see for QSBS stacking purposes is called a charitable remainder trust. Sort of the big picture is that a charitable remainder trust is a type of trust where a non-charitable beneficiary, so an individual, usually the grantor themselves, is the beneficiary during a set term. The term is usually either a term of years, up to 20 years, or the grantor's lifetime. But in practice, for this sort of a trust, it's usually a much shorter time period, like 5 or 7 years. And so you set up a charitable remainder trust for, let's say, 5 years. You get distributions each year, at the end of each year, from the trust, and then at the end of the term, whatever's left over in the trust goes to charity. Typically, it's 10% of the initial funding amount roughly goes to charity. That's the minimum amount that you can do while still qualifying as a charitable remainder trust. But the idea is, you're giving away some amount to charity. You're also getting an upfront charitable deduction. But importantly, you're getting the big QSBS tax break that you wouldn't have otherwise gotten on those shares. And so if you put, $5 million of stock into the charitable remainder trust, you're going to end up getting around $4.5 million back, and you're also going to be you're getting an upfront deduction. So basically you're getting $4.5 million of shares back, plus about a $250,000 of tax benefits. So it's a pretty it's a pretty powerful tool versus just doing nothing and paying in this example, $1.5 million of tax.
And that's right. And so these are two vehicles. They, at a high level, unsurprisingly to most people, seem pretty similar. I think it's worth drawing out the major distinctions here between these two types of trusts. A non-grantor trust, as Peter described it well, involves giving shares to someone else, and they get the trust on their behalf, gets the benefit, which means that you, as the person with the shares originally, are giving them away, right? They're no longer yours. Typically, you're giving them to one of your kids, sometimes other family members, but you're giving them away. And so this is a vehicle that is typically used by people to set up their kids or another family member with shares. Of course, there are ways to benefit from your kids having more money down the road, but ultimately you lose control of those shares. So it's a huge benefit. You get to keep all the money in the family, but you're giving it away. A CRT, by contrast, because the ultimate beneficiary is you yourself, you get to keep the money. The trade-off is you're keeping a little bit less of it. You're giving some of it to charity. You're still paying a little bit of tax for a variety of esoteric reasons. So a non-grantor trust is going to have slightly higher returns, but you have to give the shares away. A CRT is going to have slightly lower returns, but you get the money back. The other major difference here is timing. A non-grantor trust you can do really any time, and in fact, the earlier the better. With a non-grantor trust, you're giving the shares away to someone else, and so you are using up some of your lifetime gift tax exemption, estate tax exemption, by giving the shares away. So if you give them away when they're worth $10 million, you're giving up $10 million of that exemption. I'm sure you all are at least basically familiar with the gift exemption. That's a big chunk of your lifetime giving. By contrast, if you do this in the early days of your company when the shares are only worth $1 million, then you're only using up $1 million of your lifetime giving, and that's a big benefit. So non-grantor trusts you typically set up well in advance. You still are welcome to set them up, farther down the road, even right near the time when you're going to exit. But there's more flexibility, I guess, is the point in when you set up a non-grantor trust. A charitable remainder trust, for a variety of reasons that are beyond the scope here, is going to have to be set up in the weeks or probably even days you close your sale. That timing can be fraught and can be challenging if you don't have full control over the transaction. And so CRTs are a little bit tougher to implement in this context. We've done a lot of them. We get it done. It's a little bit tougher. So it's worth looking at both. They have pros and cons. One reason that CRTs are even doable and a major kind of value add on Valur's part is whether you're doing a non-grantor trust or a charitable remainder trust or any of the dozens of other trusts that we have for other purposes. We've built systems to get these things done very quickly. If you had hired a traditional lawyer to do this, it would have taken weeks or probably months to get these vehicles in place. Then you've got to get the assets transferred. It's a hassle. It takes time. You got to work with the company's lawyers. Valur can set these up in 24 hours. And we do so, by the way, for free. So the timing and the cost should never be a barrier to entry for anyone or their clients. You should be exploring these things and assuming we can get it done. With that said, the earlier you make contact, the better. It's always good to have the full panoply of options available to you, but we can always help. So don't never think it's too late, never think it's too expensive. Valur can almost certainly help. Peter, a couple of questions here on the technical side that I think are worth answering. The first, I guess, let me answer, or one of us can answer Mike's question, which is I think pretty straightforward. The payment from a CRT is taxed as ordinary income or long-term capital gain. I guess Peter, you want to take that one on?
Yeah. So that's a good question. So in general, the income that's being distributed out of a charitable remainder trust is taxed the same way that it would have been without the charitable remainder trust. So if it's treated as long-term capital gain inside of the charitable remainder trust, then it's treated as long-term capital gain when it's distributed. In this case, there's the gains excluded. And so you wouldn't be paying tax on the distributions. The distributions would be non-tax, like the income itself is excluded income. And so there's no income to tax. But in general, a charitable remainder trust, the distributions are treated the same way as the income would have been in the hands of an ordinary person.
Yeah, the way I think about it is that the trust is never going to kind of penalize you. You're going to keep the treatment, and if the treatment is favorable, you're going to get it. And so, as Peter said here, if the shares are QSBS eligible because they went into the trust, then when they come out, they're going to be QSBS eligible. You're not going to pay tax, and that's a big part of this benefit. You put 10 million of shares into a CRT, and you take those distributions over the years. Basically, 10 million, not quite 10 million, is going to come out completely tax-free. That's the big benefit. Other question here is Stevens, and this is a kind of a technical legal question. Peter, are you comfortable?
So the statute says each taxpayer gets their own exclusion. There's no beneficial ownership rules. I think those would have to have been written in the statute if they wanted to impose those. So, for example, if you set up a non-grantor trust, it files its own tax returns, it pays its own taxes. And so if you let's say you gave $10 million of stock to your daughter and $10 million of stock to a trust for the benefit of your daughter, the non-grantor, assuming that the trust is a non-grantor trust, the trust could never make distributions to your daughter, and the trust could just pay its own taxes every year. Your daughter could also pay her own taxes every year. It's clear that your daughter and the trust, although your daughter's a beneficiary, it's clear that they're not the same person for income tax purposes. They're not the same taxpayer. And so I think it'd be pretty surprising if the IRS, for example, issued regulations saying that they're going to treat two different taxpayers as a single taxpayer for these purposes. I think they'd have to pass new legislation to do that. But there's not a lot of case law in general on QSBS, not just on this question, but on anything, because the rules are relatively new. So basically, the modern version of QSBS was enacted in 2010, and people first started claiming it essentially in 2015 because of the 5-year holding period. And so it hasn't been around for that long, and there hasn't really been a lot of cases on it. and the IRS never issued regulations like connected to the statute. And so really all we have to go off of is the statute. But the statute says each taxpayer gets their own exclusion. So that's sort of the consensus that people have been using.
That's right. So the bottom line is there are a couple of vehicles that are valid here that our clients pursue that are doable. As you're exploring this for yourself or with your clients, we encourage you to reach out. Really, anyone who has a company that has kind of gotten its legs under it should start thinking about whether it makes sense to pursue one of these vehicles or one of these stacking approaches. And certainly, once you have an eye on the exit, even if it's a year away, even if you haven't even started shopping around or talking to anyone, it's worth getting in touch to talk about whether this is going to be relevant to you and your clients. So that's the bottom line pitch here: is never too early. Get in touch and let's discuss whether it's a fit.